What else we got, Steve? New stuff, exciting stuff, dynamic stuff, an IPO maybe.
Yes, we have a new IPO hitting the London market, and it's the Prince's Canned Tuna Company. No, I'm joking. We did sort of consider covering the Prince's Group IPO, but I decided to pick what I thought was the more interesting one out of the two. And by the way, Prince's Group is probably worth a look as well, because it's going to IPO at actually a decent price, I think. And it also owns a Napolina brand. But Steve and I was talking off air and said, who buys branded tuna? And if you're going to buy branded tuna, why buying Prince's over John West? I just don't see why that would happen. But we're going to cover Shawbrook Group, which is they want to tell you they're a fintech, but we'll have a look at that. I would call them a savings and lending bank. I don't think they're a fintech. But look, we'll have a look at it. It's a new IPO. It's coming to the London market. It's going to be priced around the sort of 2 billion mark. That's exciting. And we'll see. And it follows on from Beauty Tech, which I think launched the other day. And I think they generated about 300 and something million. So there's a little bit of interest coming back into this London market, Stephen. It'll be interesting to see where it goes from here. But a little bit of company history for you anyway. Shawbrook Group, founded in 2011. It's one of those new banks. I would call it a specialist savings and lending bank. It says it focuses on a customer-centric approach, so aiming to serve the needs of UK businesses, property investors, homeowners and consumers. What they say are segments underserved by mainstream banks. If you've been in the market for a while, you might remember this company. It was listed previously on the London Stock Exchange, but it was taken private in 2017 for about 870 million quid. Two private equity firms kind of sellotape their money together. BC Partners and Paul Institute Capital formed a company called Marlin Bidco Limited, and they took it private. This current IPO is essentially a return to public markets, and they think it's now positioned to capitalise on strong performance. So I've had a look at the kind of last sort of 12-ish years, which was the sort of longest date they gave me for their growth, Stephen. It's pretty impressive growth, really, over that period of time. The loan book, Steve, back in 2013, that's the end of 2013, was about 1.4 billion. It's now 17 billion. And this is from their half one 2025 report. They were underlying PBT of about 168.6 million quid. That's up 35% year on year. They said that the PBT CAGR, so that's the compound average growth rate, compound annual growth rate for PBT has been at 30 over the last 12 years. Adjusted return on tangible equity of 18.3%. CET1 ratio 13.1%, so that's fairly healthy. And they said the cost of risk, this is just a measure of expected credit losses, was about 42 basis points. They've set themselves an ambitious target, which I don't like the sound of. It's called 30 by 30. Essentially, they want to double the loan book to 30 billion by the end of 2030. I don't really like people saying they want to double the loan book by a set period, because I think that might encourage less than stellar lending. I would just say look to grow your loan book at the rate it's growing at, really. So in terms of value, they think it's going to be about 1.8 billion to 2 billion quid in valuation. If you want to give that a price to earnings ratio based on the information I just gave you, you'll be looking at between 8.1 and 9.1 times earnings. Price to book ratio, Steve, so add a 2 billion valuation, that would give you about 1.2 times book value. Relative valuation, implied valuation, if you want to consider that in line with other mid-cap financials, you're looking at about 8.1 to 9.1. It's cheap if you compare it to the sort of FTSE 250, which is where it'll be sellotaped in. That trades at about 12 times earnings. But if you compare it to NatWest or somebody like that, you're looking at about 9 times earnings. So you're a little bit under that. That's pretty good. Book value is similar to that of its listed peers, Paragon Banking Group and obviously Close Brothers. I look through the prospectus, so you don't have to. There is a best and worst kind of area of it. I would say the best parts are the strong growth and strong profitability. 30% CAGR in underlying PBT since 2013 is very strong. Return on tangible equity of 18.3 demonstrate a proven model, I would say, for high returns. The loan book is 97% secured against an asset, which I would say is good for the sort of asset quality kind of area. They assert in the prospectus that they've got no exposure to high risk US credit, private credit markets, or any collateralized loan obligations that were causing concern in the US that we covered briefly last week, I think. The IPO is really there to enhance brand recognition and to provide them with a wider range of capital sources. This is not going to boost the balance sheet of Shawbrook, and I'll explain why in a little while. But there's going to be a small free float, Steve. The free float's going to be about 10% of its shares following admission. It could go up to 21% if there's an over allotment option is exercised. I'm not sure it will be, Steve, because it's a bank at the end of the day. We've got to get excited about it. I'm not sure that's going to happen. But a small free float for anybody who doesn't really come across that term before just means that there's going to be lower liquidity for buyers and could mean that there's higher price volatility when events happen. A significant portion of this IPO is going to be a secondary sale by its private equity owner, Marlin Bidco. They're looking to realise part of their investment. Essentially, the money is going in their pockets, not in the company to fund the growth. Not that they've kind of needed it up until this point, but we'll see. Steve, it's going to launch with no dividend. They said that their strategy is growth focused, meaning that there is not going to be a dividend on offer initially. We'll see if that changes. A couple of areas that I thought were maybe just worth drawing to your attention is that the 2024 full year profit dipped a little bit when compared to the prior year, so 294 million PBT versus 302. Investors have got to be confident that this H1 2025 performance is a sustainable trajectory and not a cyclical peak. I saw that the reviews of Shawbrook said that there's basically a bit of an issue with the bank's strategy on deposits. Some people say they offer the best savings rates only to new customers and give inferior rates to their loyal savers. And this is obviously detrimental to a company that is essentially asking for deposits to fund its loan book. That's not always the best thing. And they say that they talk a lot, Steve, about being a digital banking platform, but they don't actually have an app that its customers can use. They have an online savings portal, but to say that it's rudimentary would be a very I would be going very under with my criticism there. I think the portal is terrible. And the lack of a modern app, I think, is a massive disadvantage against its challenger competition. I had a quick look, though, on Trustpilot as well, Steve. Essentially, it's given a rating of about 4.83 out of 5 on Trustpilot from thousands of reviews. That's rated as excellent. The customer experience said that they think it's efficient and relatively easy to use and competitive rates on its savings products. The negative reviews said that were largely above interest rates for customers that have been there a while and the online portal being shite. So look, I think they've got to focus on enhancing digital tools, I would say, but also they look like they've got some underwriting expertise in the business and they've got a little bit of multi-channel distribution. The bank said they are currently working on new technology, Steve. You wouldn't believe they're working on artificial intelligence across their operations. They reckon this will enhance efficiency and reduce the cost of risk. But I think the current core concern for them is this lack of a dedicated mobile banking app, Steve, which is it's got to be a standard. I can't understand why it isn't. The online portal, I guess, stops people fiddling with their savings and maybe makes it add some friction to getting your money out, which might make the deposits a little bit more sticky. But I think it also hinders customer experience when it comes to a digital banking platform. But yes, I actually think this is quite an interesting one, Steve. I think it's going to come on the market at a relatively decent price. I am marginally interested in seeing how it goes on, Steve. Maybe one for the watch list. Any thoughts on that?
It's always interesting to see banks, especially doing things slightly differently. And I share your reservations about an ambition that is grow this loan book, especially if it sounds like grow this loan book at all costs. It'll be. They do report a number, as you say, returns on ROTCE, basically returns on tangible common equity, which will be something you can use to monitor to see exactly how that underwriting is going in the case of loans and whether they're still as profitable as they are at the moment. Because as you say, 18.3 is very impressive. That's way higher than the US banks in the main. Admittedly, they operate in kind of smaller niches and they have nothing like the same scale. But an 18.3 return is very, very impressive. Can they hold that with potentially lower interest rates, but certainly while they look to try and grow their loan book by 20, whatever you said, 30 or so, and with a potential view to, well, interest rates could go anywhere in that time, and demand for loans and mortgages might be anything or nothing. I'm not so sure, but I would keep a close eye on that number and how that number develops, because if they think they can grow while they're maintaining that rate, good luck to them. They have some of my savings, I think. You mentioned their lack of an app, and I think that is something that's. I can't see why they wouldn't have one. They do, of course, as we said off air beforehand, involve themselves via Monzo, which is an app that, well, whatever you think of it, and we both like it, it's very popular in the UK. Their savings pots, at least some of them, are powered by Shawbrook, and that gives them a kind of interesting presence on. I like that, incidentally, being the one of at least the savings providers for a platform like Monzo that has quite a few customers. Lack of a dividend is interesting to me. I kind of think in general a lot of UK companies pay dividends when they shouldn't. I don't know whether that's the right move for this organisation or not, or whether they're being maybe a bit more high-minded than they ought to about the market that they're coming into, and whether UK investors will really get it in a certain way. This isn't the easiest company to get in the first place. I think it's a bank that tries to do things differently. You need to think carefully about what their strategy is and how it compares to other things that are on offer at the moment from banks which have, generally speaking, done very well in terms of share prices over the last sort of 12, 18 months or so, probably back to last February. Also, I think is around the time that things started really picking up for them. And virtually all of them have at least doubled in the big bank sectors here. So we'll see on this one. I think I'll probably take a look at how it lands and look to pick it up from there. As you point out, low liquidity exaggerates moves in either direction. If you want to try and find a seller, you might find it difficult to in a hurry. And if you want to try and buy the thing, you might find it difficult to find a seller as prices move around a little bit here. So I'll see how they kind of go when they come out. My sense is it could go one or two ways. But this is more interesting to me than the tuna company. I had some of my colleagues at Full UK checking this out, and it turns out, by the way, tin tuna can't float. It just doesn't. It sinks. And that's like the kind of DD we did as far on that one as we were interested in. But yeah, Shawbrook, much more interesting. But let's. I need to have a closer look at the kind of niches they think they operate in. Is my starting thought here.
When I was having a little scout around, Steve, just before we finish, I did stumble across one of their new products, Steve, which I had not considered something that you would have to search for. But they actually offer a wedding loan, Steve, where you can loan between £10,000 and £50,000 to spend on your wedding, and the top rate, the highest rate that you will pay, is a mere 35%. Annually. And I must say, if you're taking out a £50,000 loan over 7 years at 35% to get married, you need to give your head a wobble, because that is
No, you
not
come
sensible.
and speak to me if you want to borrow £10,000 at 35% to get married. I'll lend it to you. I'll find a way to lend it to somebody at that kind of rate. I'll lend it to you at 30. How's that sound?
You only need to make a couple of those, Steve, and your return on equity is going to look amazing.
You do until
Rappers
they
are
go
the
bad, yeah.
yeah. Which they're inevitably going to do if somebody's going to loan £50,000 at 35%. Yeah, inevitably. Those people are not making sound financial decisions.
No, and their plan is apparently to consume it. So you were at a wedding last weekend. I'm at a wedding. Well, actually, by the time this goes out, I'm at a wedding today. And if I find out that the people involved in this have taken out a wedding loan from Shawbrook or anywhere else, for that matter, at 35%, I will be. Well, I'll be having some serious words with somebody before storming off angrily. I think in my case, we need to get into the wedding loan business, Steve.
That is one of the things we could do with our money. I'm just looking, Steve, on here they say they were the double gold winners of the MoneyNet Best Personal Loans Provider in 2021 and 2022. Christ, what are the others like? That
Best for
is
who? Best for who?
best for people with no credit.
Yeah, peer lending doesn't get you that kind of return. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.